Good afternoon, Mr. Olamide. Can you hear me?
Yes, I can hear you loud
Good
and clear.
afternoon. Good afternoon. You're welcome. We'll be starting the webinar by 1 p.m.
Okay.
And a very big welcome to our attendees. Thank you for joining us today.
Very well.
Good afternoon, Mr. Ikechukwu. Can you hear me, sir?
Good afternoon, I can hear you.
You're highly welcome. We'll be starting the webinar by 1 p.m.
All right, that's fine. Thank you.
You're welcome.
Thank you very much.
Okay, good afternoon, everyone. Welcome to another exciting edition of the ES Practical Lawyer webinar series. My name is Jessica Akinedu. I'm the moderator for today's webinar. At EST Training Limited, we provide comprehensive continuous professional learning with courses and training across various areas of practices. We have tagged this webinar series the Launch Our Webinar Series. It is slated to hold at 1 p.m. during lunch break every Tuesdays and Thursday, respectively. After every section, we provide the resources in easily accessible format on a go for everyone who is interested. And we're streaming live on YouTube and on Facebook. And today's topic is tax issues in property. Property taxes in Nigeria has become a very complex one in recent years with variety of high-risk compliance difficulty. Our panelists today will be discussing a high range of tax issues that commercial property owners should be cognizant of, as well as some case studies, pitfalls to avoid, legal loopholes, and the way forward. If you have any question while the webinar is going on, please do type in the Q&A or raise up your hand, and in due time it will be answered. It is with great pleasure that I introduce our speakers for today, Mr. Olamide Obaji.
Mr. Ikechukwu, can you hear me, please? Just to confirm it's my internet.
Yes, we can hear you. I can hear you, but it looks like
Okay, great.
Just got bumped out. Sure, she'll come back soon. My apologies to everyone here. I can hear you, Mr. Olamide.
Hello, good afternoon, everyone. Please, can anyone hear me?
Yes, we can.
Oh, I'm so sorry, it's my internet. Okay, we'll be
Yes,
starting
we can
today.
hear you.
Okay, thank you so much. We're starting today's webinar Hello everyone, welcome to another exciting edition of the ES Practical Lawyer webinar series. My name is Jessica Kenedu. I'm the moderator for today's webinar. At ESU Training Limited, we provide comprehensive continuous professional learning with courses and training across various areas of practices. We have tagged this webinar series the Launch Our Webinar Series and it's slated to hold at 1 p.m. during lunch break every Tuesdays and Thursdays respectively. After every section, we'll provide the resources in easy accessible format on a go for everyone who is interested. And we're streaming live on YouTube and Facebook. Today's topic is tax issues in property. Property taxes in Nigeria have become a very complex one in recent years with a variety of high-risk compliance difficulty. Our panelists will be discussing a range of tax issues that commercial property owners should be aware of, as some of case studies, pitfalls to avoid, legal loopholes, and the way forward. If you have any question while the webinar is going on, please do type on the Q&A or raise up your hand, and in due time it will be answered. It is with great pleasure I introduce our speakers for today, Mr. Olamide Obajimi, who is a senior associate and a tax at Allowance Ajayi LP. He'll be speaking on risks and returns and lease incentive. And we also have Mr. Ikechukwu Nwana, who will be speaking on depreciation and capital work deduction and lease surrender payment. Over to you, Mr. Olamide.
Okay, thank you, Jessica.
You're welcome, sir.
Everyone can hear me?
Yes, we can.
Okay, good. So we'll kick off as soon as we can. So basically, I won't try to bore you with taxation. At the same time, I will try and be as simple as possible, in discussing all the issues. And there's something about my own presentation is that because tax is a unique, field of study or unique professional, point of area, I like talking about taxation in itself before I move to issues around taxation. So for me, I try to define taxation as a compulsory payment. And it is not just compulsory, it is compulsory because it is backed by law. And because it is backed by law, it must be paid. And if you are trying to understand the concept of tax in itself, you must look at the base in which the tax is going to be applied on. So for the purpose of taxation and by virtue of all the provisions of our tax laws in Nigeria, tax is either payable on income, profit, gain, consumption, and on instruments. So before we go to the nitty-gritty of the presentation, I would just like to quickly break that down. When you're talking about income, probably income from employment, when you're talking about profit from business, either as a sole proprietor or as a company. Then when you're talking about consumption, then we talk about our value-added tax, sales tax and the likes. Then on instruments, you look at stamp duties. And we are aware that, delving into commercial business is one of the lucrative areas in which a lot of entrepreneurs are going into lately. And it is important for us as professionals, as players in that industry, to understand some of the rudiment of taxation. Like it is said, that tax is as important as the life of the business. And if you are going into a business, you must look at all the tax implications before delving into it. So quickly, I will look at the regulatory framework generally for taxation in Nigeria, and especially those ones that affect property, tax in Nigeria. So I'll look at the Company Income Tax Act, which is the regulatory framework for the taxation of companies in Nigeria. I'll look at the personal income tax, that is for individual in business or in employment. Then we'll look at capital gains tax, is the tax we pay on disposal of chargeable assets. We'll have stamp duty tax, basically the tax on instrument of transfer, of property within the space. And we look at value-added tax, the tax payable on goods and services. So in looking at the CITA, that's the Company Income Tax Act, and how it affects, a business, engaged in commercial property letting or sales, we must look at the provisions of Section 9 of the CITA, And if I may just quickly look at it from my slides here, it talks about agency fee or management fees received for the management of property. Only the management fee, that is, so when you're looking at management fee, you are looking at a company that is managing commercial properties. So in the course of managing commercial property, either their agency fee or their management fee for the purpose of managing those properties, that is liable to tax under the SITA. Well, you should also know that when we are talking about SITA, we are talking about incorporated company, and incorporated company is engaged, in the business of letting or building, commercial properties or properties as the case may be. So if you look at Section 9 tax the profit of a company accruing, derived from, brought into, or received in Nigeria. So I'll quickly jump to where it concerns us, and includes rent or premium arising from right granted to any person for use or occupation of any property in Nigeria. So when we look at the provision of this SITA, it's more or less talking about letting. But we have instances where a company will be in the business of the sale of building and the likes, land and building and the likes. So it is important to know that for the purpose of taxation, it is not just the premium or the rent or the management fee that is received by the managers or by the enterprise in itself, but where the enterprise is also engaged in the sale of building, either it builds to sale, either it builds on behalf of people, wherever the case may be, those activities are also liable to taxation in Nigeria. Okay, so basically, where a company is the beneficial owner of a property, you know that the company is in the business of letting. Where the company is building to sell, you know that those buildings will constitute its inventory, and when it makes sales, and definitely the sales minus whatever costs incurred in building those properties, will be considered in determining the taxable profit. So for personal income tax, where a person is in the business of management of property, like we said initially with respect to company, when an individual builds properties to sell, the regulatory framework for the tax of every profit derived from that activity is the Personal Income Tax Act. And like I said, or like is the case with companies, whatever rent that an individual must have received in the course of management of the property, either is doing it in his name or doing it in the name of a business or trading in the name and style of something, then definitely whatever revenue it derives from that activity is going to be liable to tax. And up here, we can see the rates of tax with respect to persons in business. And it is also important to state that for a person in business, if you are engaged in the business of property management, sale of property and the like, and you are doing it in your personal capacity as a natural person, or trading the name and style of ABC and Co., or trading as a partnership, then you must file your returns on or before the 31st of March of every year. So your base of assessment preceding year basis means that the profit you derive from year A is going to, or year 1 or year X is going to be liable to tax, or the returns for those activities are liable to be filed with the tax authority in year 1 or year 2. So the next is capital gains tax. And we must understand the fact that capital gains tax is a regulatory framework that tracks chargeable gains. And when you're looking at chargeable gains, it means chargeable assets. So the meaning of that is that not all assets are chargeable assets. So let's look at an example of a company that is in the sale of building. That means the company construct building to sell. In such instance, such company is in the business, of selling building, either land or building, and as such, the proceeds from that sale, notwithstanding the fact that it looks like an asset, but for the purpose of the business of that person, it will be classified as inventory. So what I'm saying in essence is that chargeable assets are assets that you owed. Either you owe them, for appreciation, or you just owe them as part of the asset of a company. So in that instance, then that asset will be liable, when you dispose them, it should be liable to tax under the Capital Gains Tax Act. But when you're in the business, of selling properties, selling buildings, selling land generally, then those will not be chargeable under the Capital Gains Tax Act, but the Company Income Tax Act. And generally, the rate for taxation of gains from disposal of assets is at the rate of 10%. I think that's respect. Then the next is stamp duties. So stamp duties are generally duties that you pay on instruments. And by virtue of the Stamp Duties Act, it is very, very clear on when a transaction will be liable to tax in Nigeria. So where you execute a document or an instrument in Nigeria, whether it is in relation to anything elsewhere, is going to be that instrument must be stamped in Nigeria. Whether you now execute that business elsewhere, but it is in relation to a thing to be done in Nigeria, then that activity or that instrument is going to be liable to tax in Nigeria. So definitely, when we are looking at stamp duties, when you are managing, a property, a commercial property, and you issue rent agreements to your tenants, then that is an instrument. It relates to something to be done in Nigeria, and it is executed in Nigeria. As such, stamp duties must be paid on that instrument. Or you are disposing an asset in the course of your business, then definitely the instrument of transfer of that particular asset must be liable to capital gains tax. And if you look at the slide, we've said that rent, where this is rent between 0 and 7 years, it's liable to stamp duties at the rate of 0.7%, and if it's conveyance generally is at the rate of 1.5%. So the next thing is value-added tax, and we must be able to bifurcate this into where the commercial enterprise is rendering a service and when it is selling building or land and building. So when it is rendering a service, so for example, if it's a management service, then the law is that that is going to be liable to VAT. But before looking at delving into the constituent of this, it is important to even look at the VAT Act to see the definition of what constitutes goods or what constitutes service for the purpose of charging VAT. So the VAT Act, as amended, amended 19, 20, and 21, but at least the controversy around, sale of land, sale of building, and the likes has been resolved by the virtue of the Finance Act, that has been passed in recent time. So the VAT Act defined goods as all forms of tangible property, movable or immovable, but does not include land, building, money, or securities. And services to mean anything other than goods and services provided under a contract of employment and includes tangible and income. Well, let's leave services for now. Let's concentrate on goods. So that means that for a good to be liable to VAT, it must be a good that is defined by virtue of the VAT Act and tangible property, but it does not include land and building. So the essence of this is telling us that where land or building is being sold is not going to be liable to VAT as such today. So that is that with that. And services to anything other than goods or services provided under a contract of employment and include tangible and corporate property over which a person has ownership right, from which he derives a benefit and can be transferred from one base, exclude interest in land and building. So the new definition, in the Finance Act, I think 2020 or 21, has resolved issues around, whether land and building, whether rent is liable to VAT. But before this was resolved, it would be good to just take a step back to see what was the controversy and how this has been resolved. So before the Finance Act 2019 and 2020, there was no definition for goods and services under the VAT Act. So there were different interpretations. Most of the time, lawyers go to say, see, since the VAT Act did not define goods and services, then the best thing is to go and look at what the Sales of Goods Act says about goods and services. And if you look at the definition of the sales of goods with respect to goods, then ordinarily it should not qualify. And that is one of the arguments that the lawyers were advancing, before the recent amendment. But if you look at the definition of supply of goods, which was defined by the old VAT Act, it says supply of goods means any transaction where the old property in the goods is transferred or where the agreement expects contemplate that this will happen, and in particular includes sales and delivery of taxable goods or services used as a business, letting of taxable goods on hire. And the word letting of taxable goods on hire has been, the stronghold of the tax authority over the years to say, what, if a building is a taxable good, and when you let it out, it should be liable to to VAT. But let's look at what, notwithstanding, the definition of the, in the Act, the FRS came up with their circular to say, okay, for commercial building, VAT will be liable, but for the residential building, VAT will not be liable. And, it's the slogan of taxmen and lawyers that circulars of FRS is not the law, and that it has been made in plethora of authorities that the circulars or guidelines or rules that are released by FRS with respect to tax issues are just the FRS understanding of the provisions of the law and do not constitute law. But if you look at all the judicial interpretation of issues of this nature in the past, then we'll see that there have been a lot of controversy. And I will start with transfer of incorporeal rights, which could be a right in land, right in building. And the first case I consider there is FBIR and Ibile Holding, where the defendant was the business of building, selling, and leasing properties for commercial purpose. The Federal Board of Inland Revenue has said it's transactional to VAT. And what was said? They said it was supplies of goods and services. So the supply of goods and services that we define here was the basis of the decision in FBIR and Ibile Holding. But let's go back to CNOC and Sapetro versus FRS. In CNOC and Sapetro, what happened was that the right in an oil mining lease was transferred from Party A to Party B. And FRS issued an assessment for VAT saying that it is transfer of goods. And this matter went before the Federal High Court, and it was clearly decided that the transfer of a right, an incorporeal right, does not constitute a good, neither is it a service, and should not be within the purview of the VAT Act. So based on this judgment in CNOC and Sapetro, lawyers, tax consultants started arguing that if the right in an intangible property like an OML is not liable to VAT because it's an incorporeal right and it is neither goods nor services, then the same should apply to land and building because the right in a land is also an incorporeal right. So let's go to Momotato and UACN, where the court now looked at the whole situation and said, you know what, where you sell land, then it should not be caught by the provisions of the VAT Act. But where it is building, then definitely the building, it actually didn't say building, but it said, however, the judge clarified that services rendered in developing the land, such as sand filling, tarred road network, electricity, and so on, should qualify as supply of service and therefore liable to VAT. So it was a suggestion that, if the court can come to the conclusion that, this is going to be liable to VAT, then building is a service on the land, or the act of building is a service that has been done on that land, and as such, it should be liable to VAT. That was our motto. But all these were before, the amendment to the VAT Act by Finance Act 2019 and 2020. It's also surprising that even after, the amendment to the VAT Act by virtue of Finance Act 19 and 20, two cases came to light after the amendment. The only issue was that these cases had been in the TAT before the amendment of that law. And the TAT had to deliver, ruling or judgment on this matter, even after the VAT Act had been amended by the Finance Act. And the first one was SA Holding. And the irony was that the judgment was delivered the day after the other. SA Holding and FRS was delivered September 2020. Chief Ella and FRS was delivered 9 September 2020. So the SA Holding case, which was at the TAT in Benin, held that the list of real property, whether for commercial or residential purpose, does not amount to a supply of goods and services, and as such is outside the scope of the VAT Act. But if you look at Chief Ella, in Chief Ella, they went back to definition of supply of goods in the VAT Act before the amendment, and I said, see, it is a letting of a taxable good, and as such, it should be liable to VAT. And they relied on the FRS information circular that I earlier talked about. So if you look at the circular, like I said, the circular is not law, it was the understanding, but you can see that this controversy were so much that there were so much uncertainty when businesses were planning on how the law will affect their business in relation to VAT, especially in relation to commercial properties. And you can see that it's so good that the development in Finance Act 2019 and 2020 led to rest controversies around commercial properties. Jessica, I remember you said Mr. Ike would take incentives available to commercial property. So I'm just going to jump that, maybe just to mention by passing that when you're in the business of commercial enterprise, you either in the building or letting, you have, under the law to apply for pioneer incentives, which give you 5 years tax holiday. Also, Section 23 of the CETA exempts, dividend and rental income received by a real estate investment company on behalf of its shareholders, as long as about 75% of dividend, has been distributed to the shareholders within the year. So I'm just going to go, and I think Mr. Ike is going to take capital allowance too and loss relief. I'm going to jump that I won't, go into his territory. Okay, so the next thing I just want to talk about are accounting consideration and tax implication. So I decided to look at the accounting consideration because if you look at the FRS circular on adoption of IFRS, some of the principles under the International Financial Reporting Standard also affect the way some of these issues, in taxation are going to be treated. So in a nutshell, I'm going to look at IAS 16, IAS 2, and IAS 40. These are the three standards within, or the major standards within the IFRS that may affect how a property company, a commercial property company may account and the impact of accounting for this in their tax affairs. Okay, so IAS 16 talks about property, plant, and equipment. And if you look at the provisions of IAS 16, define PPE as tangible asset used in the production and supply of goods and services. So what IAS 16 is saying is that if a company has a building and that building is his office building or that building is his factory building, then that building is a PPE for the purpose of IAS 16 and it was treated as such. And I will tell you why I'm trying to differentiate this later on. IAS 2 talks about inventory. So if you are in the business, so IAS 2 talks about inventory and it talks about accounting for inventory, disclosures, measurement, and recognition. So it tells you that you have to measure your inventory at lower of cost or net realizable value. But how this relates to commercial enterprise or commercial property business is that where an entity is in the business of selling a building, then that building in its books would not be an asset or would not be a property, plant, equipment, but will be an inventory because he's selling it. And because he's selling it, it will be accounted for under IAS 2. The next is investment property. So investment property applies to accounting for properties, land and building that is held either for capital appreciation or to earn rental income. So what this means is that if you have a property and you are using it for rental purpose, then it should be counted for under IAS 40. And if you look at the provision of the implication of adoption of IFRS, you will see that it is important, that these things are differentiated for the purpose of tax. And I've tried to extract some of the principles, stated in this circular that is going to guide, taxpayers in assessing their returns. So if you look at the part on IAS 16, the circular says that only buildings shall qualify for capital allowance. Capital allowance claim on land shall be disregarded. So it is clear that it is only building on the land that's going to be allowable for capital allowance. Entities should provide schedule or apportionment between value of land and building. Cost of employee benefit directly attributable to the cost of PPE shall be allowed as part of the cost of the asset. So this is very, very clear that if a company develops a PPE for its use, and it's used some of its employee time in constructing that asset, then it should be deemed to be cost of the asset. Cost of PPE shall be the actual cost of the PPE, and any imputed finance cost shall be disregarded. So if imputed finance costs are a finance cost that the entity just assumed, but if there are actual finance costs that can be attributable to that PPE, and if you look at the next one, it says that interest on loan used on a qualifying capital expenditure under construction can be capitalized as part of the cost of a PPE. So there's an FRS on I think that's IAS 23 that talks about capitalization of interest. So the next is cost of dismantling. So cost of dismantling should not be included as part of the PPE. I know for accounting purpose, you might decide to, want to do what we call a work back on dismantling costs for the recognition of cost of an asset in year one. But for tax purpose, that dismantling cost should be disregarded as part of the PPE of the entity for the purpose of capital allowance. So the next is IAS 40, which we have discussed earlier, that is for assets that are held for rental or for capital appreciation. And that is what you generally would see with commercial property companies. And if you look at it, it says that taxpayers shall split the value of land and building just as in IAS 16. So with respect to disposal of investment property, proceeds shall be treated in the manner as they qualify for under the CETA and under the Capital Gains Tax Act. So when you dispose an investment property, just as you dispose your PPE, there is a part of your disposal. So for example, when you dispose, that disposal will be liable to Capital Gains Tax Act, the Capital Gains Tax on the Capital Gains Tax Act. But there's something we call balancing charge. So balancing charge is the difference between your disposal proceed and the tax down value of your asset. So tax down value of your asset is the depreciated amount, the tax depreciated amount of your asset at the date of your disposal. So the difference between the two is if your proceed of disposal is more than the tax down value of that asset, then whatever you have is going to be a balancing charge. And that is why the FRS circular is saying that should be treated under capital gains tax, and that should be treated under the CETA should be treated under the CETA. Then assets reclassify from PPE to investment property are going to enjoy capital allowance. There are instances where a commercial property company can decide to say, you know what, this property that I'm using for rent, I want to convert it as office use for the company. You can see that if you look at it, you can see that I've been able to convert an investment property to a PPE. And same way, I can decide to say, oh, this part of my property that I'm using for office, let me rent part of it and rent it. So immediately I rent part of it out, the part I've rented out becomes an investment property and should be accounted for under IAS 40. So the next is inventory, which I think I've discussed earlier, and that is clear. And if you look at the circular, I think I've highlighted two things there. It said where the allowable input VAT is included in the cost of inventory shall be disallowed. So we know that VAT is input and output. So when you buy something, where you buy maybe a raw material and you pay VAT on it as your input, when you use it to produce something and you sell it, and the VAT you charge in output. So output minus your input will give you the VAT that is due. But what this circular is saying is that if an input VAT has been claimed already, do not include it as part of the cost of the inventory, because if you do that, it's going to amount to double counting. So that is start with that. So the next thing the circular says is that where inventory are purchased with the tax settlement term, cost of inventory shall be based on the cost indicated including or inclusive of any imputed interest. I want to believe that we all know that where you pay cash for a particular item, the price is usually different from where there's a deferred settlement terms. Because for deferred settlement term, that there might be an imputed interest that will be charged by the seller. So the IFRS or the ISU or the FRS circular recognizes the fact that businesses, do business on deferred settlement term and they're usually imputed interest. So with respect to those imputed interests will be allowed. Then the next thing for the property business which definitely will affect its taxation is revenue recognition. So there's an accounting standard for revenue recognition, which is IFRS 15, and it says that for you to recognize revenue, 5 steps must be taken, into consideration. And one is that there must be a contract with that customer. So if you are renting an apartment or a commercial property to a customer or to a tenant, then you know that there's already a contract. You fulfilled the first one. The second one is that there must be a transaction price. So you decide to rent it out for 5 million annually. You can see that there's a transaction price. Then you've qualified for the second one. Let's just take it simultaneously. If you are selling a property too, you've entered into a contract of sale of a building in Lekki with the customer. You've satisfied the first one. What is the price? You've determined the transaction price. You satisfy the second one. Then the next is that recognize revenue when performance obligation has been satisfied. So you decide to give the person an apartment in Lekki to be rented for 1 year period. And the 1 year period is flowing into another year. For example, if it's a June to a May tenant. So that means that for year one, you cannot recognize the old rent because the rent that is associated to year one is the rent from June to December. So you must only recognize that in your financial, and that is what is going to be taxable. So even if you recognize everything in that year, the remaining rent that relates to January to May is going to be like a deferred revenue, and it's going to be a liability in your book, and as such, it is not going to be taxed, although it may have some what we call deferred tax implication in that particular year in which you're recognizing it, but that does not mean that it's going to be affect tax. So we've been able to look at identify customer contract with customer, determine the transaction price, recognize revenue when performance regulation will be satisfied. Then the next is to the third one is identify performance obligation. Apologies. Then the next is recognize revenue when performance obligation has been satisfied. And the last is allocate transaction price to performance obligation. So that is that with the principle in IFRS 15 in relation to revenue recognition. And I think we've been able to understand how it may impact those of us in commercial properties business. So question and answer, I think question and answer will be at the end of the session. Thank you all for listening to me. I'm most grateful. Bye.
Thank you so much, Mr. Olamide. So our next speaker is Mr. Ikechukwu. Sorry, over to you, Mr. Ikechukwu.
All right, thank you very much.
So sorry, please, if you have any question, please do type on the Q&A, and after Mr. Ikechukwu's presentation, we'll be answering the questions. Thank you so much.
All right. So quickly, I'll just go through my slides. Thank you to Mr. Olamide, who has actually done a great work doing basically the fundamental work for me. He has laid the foundation. So I'll just be speaking to a number of issues that we have, which he has not mentioned or he has skipped in the process of his notes. And just to say that I have 20 minutes. I was informed I had 20 minutes, and I'm just going to deal with a number of issues. I think 20 minutes is too small for us to deal with all the issues in commercial property transactions, tax issues, but I'll just deal with a number of issues that I've been told to focus on particularly. First of which is depreciation. What is depreciation? I'm sure that's a term that a lot of us have heard before now. Depreciation refers to reduction in the value of an asset over time, in particularly due to wear and tear. So I would be illustrating a lot as we proceed, because I know that lawyers, a lot of us here, these terminologies may just be new to us. So, and I'll use a commercial property. So if there's a commercial property, due to wear and tear that we have in our typical agreements, I'm sure that those properties over time, the value of it will reduce. And that's depreciation. That's to say that the value has depreciated. So the reduction in value of an asset over time, that's what depreciation refers to. So how is it calculated? And I just try to simplify this as much as possible because we're dealing with lawyers and we're not comfortable with a number of those things. So once you're able to confirm that the purchase price of the assets, so if it's a property, and I'll just use a typical property, maybe a property in Ikoyi, the property is going for 1 billion naira. So the purchase price of the property is 1 billion naira. You confirm the lifespan of the assets. So you could just say that the property, the lifespan will be under 30 years. And then confirm what the asset will be sold at the end of its lifespan. So what's the salvage value? So at the end of that asset, what will that property, not the land now, be sold? You subtract the salvage value from the purchase price to determine the depreciable costs. Then you proceed to divide it with divide the depreciable cost by the lifespan of the asset. So like I said, the property, if it's 1 billion naira, you determine that it will last for 35 years. And then you check how much will the property, the building on the land, be sold for after 35 years. most times you realize that people, when they buy those properties, want to just demolish it and build something a lot better than is on the land already. So if you are going to sell, what's the value of that property at the time of being sold? Maybe at that time they'll just sell it for 100 million. And maybe at that time, they just say at that time it will be the building itself will cost will be sold for 100 million. So 100 million minus a billion naira is 900 million outstanding, and you then divide the 900 million over a period of 35 years. That's how you calculate depreciation. Okay, I'm sure you would realize that I've been making reference to land not being depreciable, but the building on it is subject to depreciation. So the question, and this is something, if you don't get any other thing from this portion of the lecture, something that is very critical is for us to realize that land would always appreciate, like the general, like it is known in the general palace. But the building will keep depreciating. And that's why many times, if you go to like Lagos Island, Southwest Ikoyi, a lot of those buildings that were built in the 60s are giving way to high rises. People are coming to, buy the land. They just, the property on it is almost without value to them. They just knock it down and then build whatever they want to do. So yes, the building will keep depreciating, but the land would always appreciate. And the allowance for building, the capital allowance for building is 15% at inception and then 10% subsequent years. So yeah, I've dealt with issues relating to depreciation. I'm happy to take questions at the end of the session. Another issue that I've been told to speak to is capital expenditure. This is money spent by a company in acquiring or maintaining an asset meant for production towards making taxable income. So if there are assets that the company has acquired, the property in the circumstance, maybe it's leasing those properties and it's leasing the properties out, or is using it for just taxable, it's using it for a goal that would, for an end product that would give it some taxable income. And what this means is that, just imagine that Lagwaja Nigeria Limited was the one that bought that property for 1 billion naira, and it's involved in the renting, selling of properties. At the end of the year, that property would form part of what has yielded, the capital that has yielded the income that it will pay as its company income tax. So there'll be some, so that's capital expenditure. So whatever funds, whatever monies that has been spent towards production or acquiring assets or maintaining assets that will lead to taxable income speaks to capital expenditure. Capital allowance generally relates to a claim for tax relief by companies against accessible profit when computing their tax liabilities. And what this just means is that are there capital for capital investments that would form, you can use, are there things that you can use to claim reliefs against your accessible profit when computing your liabilities? So if at the end of the year, using December Lagwaja Limited that's bought the property, are there things that would enable it to reduce its tax liability? So if its tax liability at the end of the day was meant to be 100 million naira as well, are there things it can use to reduce what it should pay as taxes? So that's what capital allowances speak to. And like the previous speaker had mentioned when he was speaking, there are a number of things, if the company is a pioneer status company, the pioneer status refers to a company that is engaged in a business that has been listed as one of those in those exceptions. Most of them are areas that the government is interested in ensuring that there is more activity in that area. So government will give you tax break for about 5 years to ensure that you actually, because of the investments you've made, that you're able to stabilize before paying taxes. So rural location incentives. So if you located your production factory, your property in a place that could help you get rural location incentives, then that may be a tax allowance that you get. But this does not relate to property, but if it's like something you are doing that leads to export, then there must be some incentives for your export. Tourism incentive, which is about 25%. If the asset, if the property is like a hotel, commercial development is a building is like a hotel which you are employing or which you are deploying for tourism purposes, then that would give you about 25% break in taxes. I have also mentioned interest incentives. If you have borrowed money, there are incentives to ensure that you're able to pay off those loans that you have. So that's it. Capital works deduction is another concept that I've been told to throw light on. Paragraph 6.1 and 2 of the second schedule of SITA allows a company to claim capital allowance on either an asset in a state of temporary disuse or on an asset yet to be used, but whose first use will be for the purpose of the trade or business subject to approval of IRS. So just imagine that the way to explain this, just imagine that you bought a piece of land, and the land, like you are moving in machineries, you are doing a lot of work to build on the land. So capital, the law allows you to claim capital allowance, on that asset because you've not started using it. However, it's going to be deployed to use when it's finally completed. So capital works deduction refers to those works that you are doing, which you would deduct because you are being allowed to develop the property or develop the asset, so that taxes can be claimed or paid to the government on that asset. So also I need to speak to issues around qualifying capital expenditures. So what are those qualifying capital expenditures that you can claim capital allowance on? The condition for you to claim capital allowance is that the assets must be owned by the taxpayer making the claim. The ownership here must be also for a relevant period. You must own the property. If it's a property, for instance, that you've sold off all of it on off-plan basis, then you may not be allowed to claim because it's been already sold off and you don't have a right of ownership over it. The asset expenditure must have been incurred by the taxpayer. So the company must have also incurred the expenditure itself. The asset must be used fully or partially for the purpose of the trade or business. So basically saying that the asset must be wholly, reasonably, and exclusively necessary to be used for the purpose of the business. So at that assets, the property you are building must be one that will lead to the realization of the income for the company that can be taxable. So the asset must also have a lifespan of more than 12 calendar months. So it has to be an asset that's really of a long-term, value. So it's not something that after 6 months, no, it has to be up to 12 months and all of that. I'm sure that this provision is made to also protect the taxman, to be sure that the property, when it comes alive, does not, the taxman can derive some taxable income from it before it's been sold or it's been anything would happen to it. Okay, so lease surrender payments. This is not very common in Nigeria, but yes, it's something that's with time we'll start seeing a lot of it. Lease surrender payments, as the name indicates, relates to the parties to a commercial lease agreement can expressly provide for early termination of the terms on condition agreed upon. The lessor can trigger the termination provision and comply with the agreed requirement, etc. payment, e.g. payment and notice as provided in the lease agreement. So what am I saying here? So let me just also explain it using common things around us. So just imagine that Eco-Atlantic, a building has been developed particularly for the United States Embassy. So I have a piece of land there and the embassy has made me just build help you develop a property there, and I go ahead and spend my funds to develop the property, I have tied them down. I've tied them down, or my client has tied them down, saying for the next 30 years they will be there, and that's why we got into that investment. So a lot of the structuring, a lot of the building, what it looks like, has been actually developed because they specifically requested for that kind of building or something to suit their engagement as an embassy. And then I've tied them down for 30 years, hoping that I'll get my money back within those, maybe after 20 years or after 15 years. And just at the 10th year or 12th year, the embassy is coming to speak to my client or myself to say, sorry, we have to shut down our operation in Nigeria, we can't continue. So we want to surrender the lease. So if you're going to surrender the lease, then it's prudent that when you're drafting those kind of long-term agreements and contracts, you put a clause that says, guy, if you're going to surrender this lease, you may have to pay me XYZ money, maybe funds to enable me restructure the property to fit what it needs to be. It will make it look the way it should to be attractive to the next commercial tenant that is coming, or something that would help me take care of the costs of funds that I've used to develop it or to sort out some loan issues that I've used to build the place over time. So it's important that, yes, at that point, when the both parties are getting into the contract, that there's a clause in the contract that speaks to, if you must surrender after a period of time, then you are required to make payments, you are required to give this notice, you are required to do X, Y, Z to ensure that the owner of the property is not left hanging. So surrendering a lease is often the case for commercial leases with no break clause. No break clause means that you're staying there for 30 years. There's no break. It's not like you'll be renewing every year, as it frees both the landlord and tenant from the obligations of a lease if either party encounter an issue at any time during the duration of the lease. The tenant, for example, may offer to surrender the lease if they are struggling to meet their obligation under the lease, such as paying rent. For income tax purposes, lease surrender payments are generally made by tenants to landlords. So to surrender the existing lease arrangement are typically taxable to the recipient and non-deduct. And okay, so typically the person that will bear the tax burden will be the recipient of the money. So the tenant is the one that will be paying, for instance, 100 million naira to the owner for the losses. So the landlord at that point to be liable to pay a particular amount as taxes, which is on the lease surrender payment, and then and it will become non-deductible to the payer. So the tenant who is there, who his business is struggling, who has to relinquish or surrender the premises, is not liable to pay any tax, but the commercial landlord would have to pay tax because he's the one receiving funds. So these are my thoughts on the issues I've told to speak on, and I'm happy to discuss or answer any question that we may have. Thank you very much.
Thank you so much, Mr. Ikechukwu. Okay, Mr. Olamide, please, if you do have any question, please do tap on the Q&A and it will be answered. Mr. Olamide, someone is asking, Mr. Martin is asking, I would like to know the treatment of right of use of assets. Oh, sorry, I would like to know the treatment of right of used assets.
Okay, can everyone hear me?
Yes, we can.
Okay, I want to believe that the person who has the question is referring to IFRS 16 on leases. And if that is the case, IFRS 15 is clear. IFRS 15 is just a financial reporting principle. And what it does is that it does not change the way a lessor would recognize or treat the asset in its own books. Maybe if we might just walk back a little bit for purpose of everyone. So the accounting standards for with respect to leases before now used to be IS 17. Yes, IS 17. And I think sometime around 2016, a new standard of IFRS 16 was introduced. So the FRS circular on adoption of FRS was, had been introduced long before. So it didn't meet, and a new one was not updated when IFRS 16 was issued. But the most important thing is that IFRS 16 really did not change anything. It introduced right of use asset and lease liability with respect to a lessee, saying that a lessee must recognize right of use and lease liability, while a lessor should still continue to recognize, the asset in line with IS 17, meaning that the lessor will classify his asset either as an operating lease or either as a finance lease. So for the purpose of taxation, nothing will still change. The provisions of the FRS circular with respect to accounting for leases, with respect to IS 17, will still apply. So what does that mean? It means that if you are a lessee, right, what you need to do is to account for your rent. The value of your rent in your accounting transaction should be the rent that is going to be deductible for tax purpose. The right of use asset and lease liability that has been provided for by IFRS 16 is just an accounting principle to just show the real situation of the contract of lease between the lessor and the lessee. So the old, implication under IS 17 will still apply, meaning that if the lessee is under an operating lease, then every lease payment that he makes is going to be deductible as an expense in his profit and loss account, and it's also deductible for tax purposes. If it is a finance lease, it is going to be treated as the asset of that entity. And as such, what will be deductible for tax is only the interest element of the payment, the periodic payment that such lessee is making to the lessor. To further break it down, maybe for the purpose of the lawyers, a lease can also be, related to an hire purchase. So when you rent out a property under an operating lease, what you pay, you are going to be paying periodic rentals. When you rent is under a finance lease, you are going to be paying periodic rental. But the only difference is that the periodic rental under a finance lease is a combination of both the cost of that asset and the interest payment. So for a finance lease, it is only the interest payment that is going to be liable to tax, that is going to be deductible for tax purpose. While for the operating lease, the whole amount is going to be deductible for tax. So just to break it down, the principles under the operating and finance lease principle, as clearly stated under the old IS 17, will continue to apply, notwithstanding that the IFRS 17 is saying that recognize right of use and recognize lease liabilities. Thank you.
All right. Thank you so much, Mr. Olamide. Mr. Ikechi, would you like to say something to add to the question, to the answer?
No, I wouldn't want to add anything. I think Olamide has done justice to the issue. Thank you.
Okay. Please, if you do have any question, please do type on the Q&A and it will be answered shortly. Okay. Someone is asking if the material will. Yes, you'll be able to get the material. Send it to your mail. Please do type your email on the chat box. Someone is raising hands. Okay, Mr. Buma, I think you're raising your hand. Would you like to say something? Hello, Mr. Buma. Hello, Mr. Buma, can you hear me? Okay, I think there is no more questions, so we'll be coming to the end of this webinar. Thank you so much to, okay, Mr. Buma, Thank you so much to our speakers and our attendees for attending today's webinar. A very big thank you to our sponsors, LLP, Bluefield, Advocate Law Practice, Ever Law Associate, DOA, and Farmville for sponsoring our webinar. And our subsequent webinars will now be by 3 p.m. And you can also watch our past webinars on our YouTube channel at My ESP Legal. Thank you so much, Mr. Olamide, and thank you so much, Mr. Ikeju, for joining us today. And we look forward to having you on subsequent webinar. Hello, can anyone hear me?
Yes, we can hear you.
Okay, thanks so much. Do have a nice day.
You too, bye.
Bye.
Bye. Thank you.